Hey everyone, DraftKings reported second quarter earnings results, which I will review in this video here. I'm also going to update my recommendation for DraftKings stock coming into these results. I did not have DraftKings stock rated as a buy, I had it rated as a hold. So you're going to want to tune in to see if I'm changing that recommendation. But let's start the video with a review of the company's quarter. So if I can get this slide to work. There we go. So total revenue increased to 875 million, representing 88% growth. The company's done a phenomenal job on the top line growing revenue. That's never been a complaint from any investor. Net loss improved to 77 million, up from 217 million. This is where DraftKings has had difficulty. The company's been losing a lot of money on the bottom line for several years. This quarter was a significant improvement. The net loss on the bottom line finally improved dramatically, and primarily because of reducing promotional intensity. This industry has been one that's been rife with intense competition, with DraftKings and its rivals offering massive promotions to encourage signups. Things like a 200% sign up bonus. So if people were to deposit $100 on one of DraftKings platform, they would get a $200 bonus. Now, of course, they can't just take that bonus out, and they're required to stay on the platform for a long time before they can cash out that bonus. But still, that bonus means that DraftKings will take longer to generate any kind of profit from a new customer acquisition, maybe even never, because a customer might sign up, play until they capture that bonus, and then once they capture that bonus, they go on to another platform that offers a bonus, play until they capture that bonus, and so on, going around the companies, just capitalizing on all of the bonuses that are in existence, and thereby never sticking with one company long enough to be a profitable customer for any one company. And so this has been a concern for DraftKings investors. And so this is good news to see that DraftKings is lowering promotional intensity, and industry wide it actually decreased as well. So that's a good sign from investors interested in this industry, is the reduction in bonuses industry wide will make customers stick around longer because they won't have an incentive to switch around to all of the other companies looking for bonuses to capitalize on. DraftKings does have $1.1 billion in cash on hand, so looking at its quarterly loss, comparing it with the cash, it's got plenty of cash to support and sustain itself until and when, if it becomes profitable. Now, one of the reasons why DraftKings has been losing so much money on the bottom line is because it's just now expanding into new states, right? It's available in around 20 states for mobile sportsbook and around 5 states for iGaming. So it's spending money trying to get legislatures to approve the gaming in their state, and then once it is approved in the state, for example, it's going to launch an online sportsbook in Kentucky towards the end of September. There's a lot of promotional activity the company engages in to let people in the state know that it's now legal to bet on sports online in that state, and DraftKings is available in case they wanted to sign up. So once they reach all of the states that they expect to reach, there's some states I don't think DraftKings is expecting to go into. A state like Utah, I don't think DraftKings expects to ever get into. I think they think they can get into California, but being from California and understanding the how the gaming industry works in California, in how strong and powerful the local gaming uh, operators are here, the horse racing industry and the local card rooms and the Indian gaming casinos. They lobby against any new entrants, making it very difficult for any new competitor to enter. DraftKings found that out in 2022 when they spent a lot of money trying to get online sports betting legalized here in the state, and they failed miserably. So once DraftKings enters into all the states they think they can get into, and then they're at their equilibrium, then they can reduce that spending considerably, and that's when investors can expect the company to start generating consistent profitability and cash flow. But that's a big if. That's a big if and when the company reaches that level. Cash flow from operations in the 6 months ended June 30th ended with negative 219 million. That was a big improvement from negative 529 million. So it's making nice progress. As such, the company is raising the revenue forecast for the year. It used to have a target of 3.19 billion. It's raising it now by roughly 10% to a midpoint of 3.5 billion. So, like I said, revenue hasn't been a question for DraftKings, and that's been the good news, is that customers, consumers continue to show that they want this service. They want to be able to bet online. They want to be able to gamble online because it's just so much more convenient. Some people live more than 2 hours away from the nearest casino. And if they want to game, they can open the DraftKings app and game and finish their session in less time than it would take for them to travel to their closest casino. So it's just so much more convenient, and consumers are saying, hey, we like this service, we want more of this. It's just a matter of legislatures allowing this to be legal in their respective states in order for DraftKings to gain approval to operate in the state. And then, if you're comparing it to brick and mortar casinos, DraftKings has the potential to be more profitable because it doesn't have to pay for all of the maintenance of operating a brick and mortar casino, all of the staff that's required, the expensive buildings, and all of that. Doesn't have to pay for that. So, if it reaches its level, DraftKings gave a long-term estimate of, when they reach their equilibrium, their peak rate, they think they can generate about $30 billion of revenue, and they're about, one. Let's say if you give them that $3.5 billion target for 2023, they're about 1/10 of the way there. So they've still got a long way to go before they reach that equilibrium level of revenue that they think they can earn once they enter into each one of the states that they are hoping they can get into. As for my recommendation for DraftKings stock, I had it rated as a hold coming into these results. These results were really good. They did make a big step forward, but I'm still not recommending the stock as a buy. DraftKings stock is up considerably this year already, and I don't like the potential for the company. The total addressable market opportunity going just for 30 billion at its peak, that's not enough for me to consider recommending this stock to absorb all of the risks associated with this stock if the reward is only about 8 or 9x from here. So the reward, I don't think the peak is not high enough, the potential is not big enough to justify taking the big risk with this company and all of the losses on the bottom line before it can ever get there, if it will ever get there. So I'm still rating it as not a buy, just a hold for now. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.